Joining us now is Brian Levitt, Chief Global Market Strategist at Invesco. Brian, great to have you back here.
Very nice to be here, thank you.
All right, so we're turning the page on the first half of the year. So tell us, what's the playbook for the second half? What's changing, what's staying the same?
So what's changing? Well, let's start with the way we came into the year. Very nice expansion globally. Fed was going to lower interest rates, oil costs were low, rates were low. It was a very nice backdrop. We ran into the war in Iran, which disrupted things momentarily, disrupted the broadening out trade. Confident now that we've seen oil prices come down significantly, inflation expectations down, rates down, that we've got a nice macro backdrop and the broadening of these markets should continue.
Yeah, the biggest story really so far has been this broadening that we've been seeing. Small caps having their best first half in decades. The Dow, I think it's the best first half in 5 years. Do you expect that to be kind of a temporary broadening, or is this a new phase of the bull market?
I would categorize it as a new phase of the bull market. I mean, we've always known that these parts of the market are cheaper. The question is, do you have a catalyst for them to outperform? And so those catalysts, which are better growth globally, and some of that's fiscal stimulus in most parts of the world, also declining energy prices is helpful. You'd like to see some policy easing. I'm not sure we're going to get all the way there with the Fed, but I think if they stay on hold, that's enough of a catalyst. And I think one of the things that people underestimate is you've seen a lot of bidding up of the companies that are bringing us AI. Market's starting to think about some of the bigger beneficiaries of that. Smaller cap companies can benefit from efficiencies. Financials, healthcare, these kind of sectors can benefit from new innovations.
We've also been seeing a rotation within the AI opportunity, though. If you take a look at the Mag 7, we have, they're all underperforming for the most part, maybe not Alphabet, the broader market, and we have names, you can't talk individual stocks, but names like Micron, Intel, Dell, SanDisk, running wild. So how are you thinking about the opportunity within technology as we head into the second half of the year?
Yeah, so we've gone from mag to lag on the 7, right? And you know what's so nice about that? In 2024, all anybody wanted to talk about was how only 7 stocks were dragging the stock market, and back then, people would have loved for a broadening market. And back then, well, what if those names roll over? And at the time we said, you hope you're in a better macro backdrop so that the rest of the market can carry it forward. And so that's precisely what's happened. Investors are a bit skeptical on the amount of money being spent by the so-called hyperscalers. What type of return on invested capital do you get? So that's now shifted to other parts of the tech sector where supply may be constrained for a while to match up with all of this demand. Very big moves in memory, very big moves in chips. That may take a little bit of a breather. I don't think we're going to roll over substantially, but that's a market that had to price in a substantial amount of new demand very quickly, and that may moderate here.
So what part of the tech trade do you still like for the second half playbook?
Yeah, I mean, well, for one, I think that there's been a significant wipeout of software businesses that may not disappear, and I'd say in many instances probably won't disappear. I think a lot of them are going to start to harness their AI capabilities to further improve. I think that there's moats around those businesses. You incorporate AI and things will improve. It's not to say that semiconductors won't, that's a long-term structural story, right? So you may just have some fits and starts around that in terms of expectation around the investment build, in terms of how long can this go on? Will they see return on invested capital? So chip companies, memory companies could be a bit more volatile as expectations around that adjust, but I continue to think that's a longer term structural story, if not necessarily a second half of the year story.
So for the everyday retail investor, how do they get their tech exposure? Is this just sitting in the S&P 500, or should they be putting their money in some thematic ETFs that give them exposure to specific parts, or maybe a software ETF?
Yeah, so there's different ways to do it. I mean, investors who have looked at how the S&P 500 has performed or how the Qs have performed, they've done very well this year, even in a year where the tech rotation has changed. And so that's okay, right? Continue to be exposed to the Qs and take advantage of that. If you want to be more specific, and yeah, there certainly are ETFs or indices that you can gain exposure to. Now, some of them have run up a lot. If you look at a semiconductor index, if you look at a new DRAM ETF that came out, those have run a lot in a very short period of time. So look for places where there's opportunities. I mean, I suggest something like software. It's been beaten up, and I think the negativity around it has just gone too far.
Okay, you've also found or been pretty bullish on the opportunity in emerging markets. Why are you still hanging your hat there?
Well, it's funny, the story around EM maybe changed a little bit from the beginning of the year. The beginning of the year was better global growth and lower US rates and a weaker dollar all historically benefit the emerging markets. The war in Iran disrupted that, and yet emerging markets continued to be a great performer, but it was a great performer not driven necessarily by the way we thought about it from a macro perspective. It was driven more by a handful of names exposed to the memory trade at the top of those indices. So I think that story has gone on, perhaps too far, but getting back to a better global growth environment, lower energy prices, perhaps a Fed that could at some point normalize the yield curve, our expectation still for a weaker dollar, all of that continues to be, in our opinion, tailwinds for EM.
If the dollar continues to weaken, what's the biggest investment implication for investors?
Historically, the biggest outperformer in a period of a weaker dollar is emerging markets. And so that would be both on the equity and the bond side. And so that would be our view. And the thing about it is investors have not experienced an environment where the Fed can gradually lower interest rates over a long period of time. And so if we get back to that moment, it's a very big sea change from where we've been. And investors are used to either the Fed gradually raising rates or lowering them to zero. And so can you get away from a strong dollar environment by gradually bringing rates lower towards the rest of the world? That should be a nice tailwind for capital to flow to other parts of the world.
So if you're right about a continuation of this broadening and a weaker dollar, and for investors to stay invested, what does the ideal playbook look like for the second half of the year?
Yeah, I would lean into what I would categorize as an expansion trade. And in an expansion trade, it's a little bit different than your slowdown trade where you want to be higher quality, mega cap, the growthiest businesses. In more of an expansion trade, you want to look for where value exists and where that expansion can help break out the value. So smaller capitals, small and mid caps, cyclical sectors within the equity market, non-US exposure, in particular the emerging markets.
And then what about within the US?
Within the U.S., I would continue to favor the cyclical sectors. I mean, when people get bearish here, I look at people getting bearish. And what are small caps at all-time highs? Financials seem to be breaking out. REITs seem to be breaking out. That's all representative of a reasonable macro backdrop or a market that expects a reasonable macro backdrop.
But is it too late to chase that momentum at this point if I'm not already invested in small caps? If financials obviously still a lagging sector in the S&P 500 as you kind of look at the sector performance, but if I'm not already invested there, is there still room to run?
I believe so. Remember where valuations were at the starting point. We had a lot of catch up to do from small cap names to large cap names. And the reason you never had that is we just didn't have a lot of growth supporting it. If you think of coming out of COVID, we had it, and then we ran into inflation and policy tightening. So we kind of clamped down on growth, and you never got that next catalyst. The catalyst here has been fiscal spend, a consumer that continues to do well, and we hope at some point an easing cycle or a continuation of it.
A lot of people, though, have been waiting for a pullback that we haven't really seen come. So for those people who are sitting in cash right now and trying to fathom investing in a market that's near all-time highs, what's your advice to them?
Yeah, it's a challenge, and historically you're better off investing at all-time highs than you are on any random day. And so we all learn in this industry when we get into it, buy low and sell high. If you look at the charts of the broad market, in actuality it's buy high, sell higher. right? That's been the reality of it. You have to ask yourself what drives a drawdown. They don't come out of nowhere. They're almost always the result of some type of policy uncertainty. And so in the last couple of years, we had Liberation Day, which gave us a 20% downturn or near 20%, and we had the war in Iran, which gave us, what, 8.5% down on the S&P 500. So those were two big policy decisions that were disruptive. Now, since those moments, we got greater clarity on the tariff rates, and we're creeping towards some type of memorandum of understanding and hopefully a greater clarity on with the war in Iran. The market certainly believes that we're heading there to greater clarity with the war in Iran. So you only get it when big policy uncertainty emerges. If we're in a world where inflation expectations are contained, we have a divided government, all of which I believe will be where we are as we move through the fall into the beginning of next year, that should be less policy uncertainty.
But how much of your bullish outlook and the expansion trade hinges on a resolution in terms of the war in Iran? Because we keep thinking we're getting closer and then we're not.
The market has moved beyond it, okay? And so oil prices peaked in early April without a full plan on where this is going. Inflation expectations peaked in early April. So the market has moved beyond it from the perspective of A, it's not meaningfully going to derail the major economies of the world, and B, it's probably not going to change central bank policy all that significantly. Now, the ECB raised rates. We can debate that. I don't think that was the right move, but it's not going to meaningfully adjust those things. Look, if the Strait of Hormuz was to all of a sudden close and the market was expecting a prolonged closure of the Strait of Hormuz and there was no way to move oil elsewhere and oil goes back up above $110 a barrel, then yeah, you may have another downturn in these markets. Your leadership may shift towards higher quality growth of your businesses, but I'm going to stand to the belief that these markets are looking behind it, and I think ultimately the Trump administration is looking to move beyond it.
Even if that did happen, would you look at that as a buying opportunity?
I would.
Okay.
I would look at it as a buying opportunity. You have to think about how cycles end. Cycles end with over-levered economies, too much excess, and a Fed that's raising rates to kind of squash it all. And I don't believe we're particularly over-levered, at least in the aggregate. Household balance sheets look good. Business balance sheets look generally good.
What is the biggest risk then at this point? Because it doesn't seem to be the war in Iran or potentially rising oil prices. What do you think is the biggest risk to the market right now?
I've been focusing very closely on inflation. And we knew where the headline CPI was going to go. That seemed pretty self-evident once gasoline prices rose. And then core CPI will follow that. Core PCE will follow that. And so the question is, does the Fed look through it? Or does the Fed feel the need to raise interest rates into it? If you raise interest rates into it, or at least signal you start to flatten the yield curve pretty significantly. In many ways, where you look at where the 10-year is, they've already gotten to a fairly restrictive place with regards to the shape of the yield curve. So if inflation were to accelerate here, that would be problematic.
What level are you looking for when you say accelerate?
Well, I would be concerned if I started to see a 5-year break even above 2.75% and climbing higher than that.
And if the Fed does decide to hike rates to try to control inflation, would you turn bearish?
Well, the good news is right now the market is already pricing in a rate hike. Credit spreads have barely moved. Stock market's near an all-time high. So no, if there was a reason why they had to start to tighten beyond that, yeah, that could start to become concerning.
Okay. All right. Perfect time to pivot to our rapid fire game of this or that. You've played. You know the rules here. Quick questions, quick answers. Are you ready, Brian?
I'm a former champion.
Yes, you are. Here we go. Second half, lean in or pull back?
Lean in.
Stay invested or raise cash?
Stay invested.
Best place for new money right now?
Emerging markets.
Market broadening, real shift or short-lived?
Real shift.
Emerging markets or U.S. markets?
Emerging markets.
Equal weight or market cap?
Equal weight.
Small caps or large caps?
Small caps.
More upside in the second half, the Dow or NASDAQ?
Dow.
Russell or S&P 500?
Russell.
AI hardware or software?
Software.
Industrials or tech?
Industrials.
Staples or consumer discretionary?
Discretionary.
Financials or healthcare?
Both. Financials.
Real estate or private credit?
Real estate.
Bigger risk, geopolitics or inflation?
Inflation.
One word to describe the U.S. economy.
Resilient.
Strait of Hormuz, resolved by year-end or ongoing risk?
Resolved.
Oil by year-end, higher or lower than 70?
Lower.
One word for the second half.
Productive.
S&P 500 price target by year-end.
8,000.
Brian Levitt, the speediest this or that I think that we've ever had. You certainly are the champion there. That's Brian Levitt, Chief Global Market Strategist at Invesco. Thank you so much.
Thank you.
If you enjoyed this Street Talk, check out our full interview with Garrett Soloway. He explains why he expects an over 20% pullback for the S&P 500 by year-end. He has a 5,600 price target.